Hey, this is Warren Redlick. I was not thrilled with the Tesla Q3 earnings call. The results were not what I was hoping for. There are some real bright spots in the call, but I'm calling this the good, the bad, and the ugly. I'm going to start with the ugly. I'm still a long term believer in Tesla stock, but short term, this was not great. Are you ready? Let's go. Hey, as I'm editing, I realized I was maybe more negative than I should have been in my summary of what happened. I think short term, the numbers weren't great. I think long term, when you listen to everything in this video, you're going to hear how promising the future is for Tesla in the long term. And that's a lot more important than the short term numbers. So I'm really excited about all the great stuff I heard in the earnings call. And we're going to play that out over the course. We're going to start off with the short term stuff, which wasn't great. And we're going to dive into the long-term stuff in the rest of the video. I'm actually going to go back to what I had done before. I realized I made a mistake. I have focused in the past on long-term view of where Tesla is going as a company and as a stock. And recently, I have gotten into making short-term predictions, which is something I tried to avoid doing. And I think I've demonstrated I'm particularly bad at making short-term predictions. So I got a couple things right, but I got a lot wrong. And I think I'm going to go back to my practice of not making short-term stock price predictions, because not just short-term stock price predictions, but short-term performance predictions, because I got a lot wrong. Before we get into the call, I want to hit on something key here, which is automotive gross margin, automotive revenue. As you look at these numbers, automotive gross margin was 27.9%. This significantly underperformed what I expected. It was not an improvement on Q2. Q2 was a bad quarter, and I expected auto gross margin to be significantly higher than Q2. It was not higher, and it was much lower than Q1. I expected, with vehicle volumes being much higher and with efficiencies from shifting to other factories, I expected we would see much, we were on a climb. We were going from 30 to 33%. There was a dip for Q2, which was understandable because of the Shanghai lockdowns, and then auto gross margins didn't come up. And auto revenue did not come up as much as expected with the volume increase. It appears that average selling price went down rather than up. I thought we were shifting away from Model 3 to Model Y. We'd increased Model S and X slightly. It appears that either it's, the foreign exchange rates, or the fact that units sell in China for less than units sell in the United States and Europe. Whatever it is, uh, average selling price was lower, and auto gross margin was dramatically lower than expected. This, I don't understand why. I'm just so stunned that auto gross margin didn't improve from Q2 to Q3. Q2 was a terrible quarter. Why didn't this go up? I don't know. Total revenues, I had projected potentially 24 billion. I certainly thought 22 billion was likely. This is down in part because average selling price of the vehicles was down. There's a little bit more here. Megapack, or energy storage, didn't delivered as much storage as I thought they would do, but didn't deliver as much revenue as I expected. I was a little surprised by that as well. Down here, earnings per share, I'm stunned. We have much higher volume of deliveries in Q3 versus Q1, and earnings per share is less than Q1. I expect, I certainly expected it, and we beat Q2, and we did beat Wall Street analyst estimates. Wall Street analyst estimates were around $1 a share, so Tesla did beat the street, but this came in well below, way below what I thought, way below what James Stevenson thought, below what Rob Maurer thought. This was a massive underperformance of earnings from what I expected. And this unfortunately translates to, when you're looking at Q4, well, okay, you're going to increase volumes a lot in Q4. Maybe they'll hit 450,000 deliveries or 450,000 production in Q4, but it doesn't look like we're going to see a big jump in earnings when we see a big jump in deliveries, because that's what happened here. We saw a big jump in deliveries from 310,000 to 344,000 deliveries, and we didn't see a jump, and we saw a decline in earnings per share. This is mystifying. And this is why I need to stay away from making short-term predictions about things like this and focus on what I see in the long term in my napkin math. Now, net cash, let's talk about the good thing for a second, okay? Net cash, $5 billion in net cash, $3.3 billion in free cash flow. These are bigger numbers than I thought. So Tesla, as a cash-generating entity, this is really good news. The cash pile went to 21 billion from 19 billion. These are big jumps. This is good news, right? There is good news here, that when you're concerned about the future in a recessionary environment, one of the things you need is you need positive cash flow to be able to survive a struggle. You need a big cash pile and you need cash coming in. And Tesla's got cash coming in. Tesla's a cash machine. I want it to be a profit machine. I want it to be growing in a lot of different ways that I didn't see in the Q3 call, but they're sure growing cash. And that's not nothing. One other thing I wanted to show you on, I think this is page 6. You have storage deployed. Storage deployed. I called this one. I got one thing right. Storage deployed went over 2 gigawatt hours. This is very positive. This is nearly double the previous quarter. It's a huge record for Tesla, and they're talking about radical growth here, 100 to 150% annual growth, or was it even more than that? I think it was like insane growth here for energy storage. Energy revenue did not go up as much as I expected. I expected this to generate at least $1 billion in extra revenue for Tesla, and that's why I thought total revenue would be higher, and that's why I thought total margin would be higher. And then I don't have the sheet handy, but the profit story, the margin, the profit for Tesla Energy did not go up. The revenue for Tesla Energy went up, but the costs also went up, and they're still profitable. That's good news, but the profit did not go up as much as I hoped for. Basically, $100 million in profit on this. But it was $100 million in profit last quarter when they only had 1.1 gigawatt hours. And solar deployed for some reason went down rather than up. I thought solar deployed was going to rise with energy storage because some of the energy storage is power walls, and power walls tend to go with solar. So we're still struggling to get solar deployment going up. That's also, a big revenue generator because solar is pretty expensive for people, and Tesla gets a lot of money for their solar. So, this is big and this is going to grow fast and that's going to matter, but we need to see it turn profitable and more profitable, and we need to see that make a difference. And then we need to think, instead of worrying about next quarter or next year, we're thinking further down the road. I think they said they're going to be deploying megapacks in other continents, that they're probably going to start manufacturing megapacks elsewhere, and that's going to grow that business dramatically. And they're expecting megapack, Tesla Energy in general, to be maybe bigger in terms of revenue than the cars. But that this is a bright spot for the future that we're seeing that kind of growth, but we need continued execution, and I'd like to see profit story coming out of that as well, and we didn't see enough profit coming out of that. So let's turn to the call.
So just to do a Q3 recap, Q3 was another record quarter on many levels. We had our industry-leading operating margin reach 17%. And our free cash flow surpassed $3 billion in Q3 and approached $9 billion in the past 12 months. As our factories ramp, we're looking forward to a record-breaking Q4. So it really, knock on wood, it looks like we'll have an epic end of year.
I just wanted to touch on that, an epic end of year. What does that mean? I think later in the call, they're talking about coming close to their 50% delivery growth, or their 50% production growth. We're not looking at 480,000 cars in Q4. Maybe we're looking at 450,000 produced. Maybe we're looking at 420,000 delivered. At some point, they said that they expect deliveries to be below production because of their adjusting to the not pushing vehicles at the end of the quarter. In other words, when I made my previous video, I was projecting, okay, we're going to see maybe $1.30 or $1.50 a share in Q3. And then you extend it out to Q4, and we might see $1.80 or $2 a share. I think we can walk that back. I think earnings per share for Q4 is going to be nowhere near $2 a share. And maybe it won't even get to $1.50 a share. And then when you walk that forward to 2023, I had been projecting that we would see at least $2 a quarter on average, or $8 earnings per share for 2023. And I'm just not that confident of that anymore. I'm not seeing the maybe as they ramp Texas and they ramp Berlin, the margins come back. Average selling price, we expected everything that looked like average selling price was going up, and average selling price did not go up. So we're going to see higher volumes, and we're not going to see average selling price go up. Is auto margin going to go up? Is our margins going to go up? Because margins did not get to where they need to be. So we're probably not, I want to say we're going to still looking at $8 a share earnings per share for 2023, but I just don't think we're there anymore. So maybe we're looking at $6 earnings per share. for 2023. And it's $6 earnings per share and a 50 price earnings ratio. You're at $300 share price. So $200 is still way too low. Last I checked, the stock was trading at $200. Even at $4 a share, I you'd have to really be pessimistic to say $4 a share earnings per share for 2023 if we're doing $1 a share in 2022. That you would have to say that earnings are gonna fall, and that doesn't look likely. It looks like earnings are gonna rise, so maybe it's $6 a share. I don't wanna get into short-term predictions, but I'm definitely gonna walk back my $8 a share because 'cause I'm not seeing it. Unless there's something magical that happens with FSD. We're just not going to see $8 a share in 2023. And then I think the price earnings ratio should be higher than 50. It should be more like 60 or 80. And then at $6 a share, you're looking at close to $5 a share, $500 a share. But even at $50 price earnings ratio and $6 earnings per share, which I think is a reasonable target for 2023, you're looking at $300 share price, not a $200 share price. And I still think the stock is worth $500 a share easy, especially when you look out longer term at where things are going. But I don't want to sugarcoat it. That the numbers weren't good, and Elon saying epic all of a sudden. What does he mean by epic? I just don't think we're going to see the numbers we want to see in the short term. I'm very pleased with some of the things I heard about the long term, which we'll get to, but short term, this was just not great.
So Q4 is looking extremely good. On the production ramp, Giga Berlin achieved another milestone of 2,000 cars made in a week with very good quality, and is ramping rapidly. Giga Austin or Giga Texas should reach this milestone very soon.
We are seeing ramps, successful growth in production in Giga Texas and Giga Berlin. I think we already knew Giga Berlin was over 2,000 a week, and now appears that at least from the last day that they produced a Giga Texas, they were on a potential rate of 2,000 a week, but they haven't done 2,000 a week yet. So they're probably going to cross 2,000 a week shortly. Giga Berlin is probably approaching 2,500 a week. Are they going to hit 5,000 a week by the end of the year? I don't see the growth looking like that, especially with Giga Texas, but that's one of the targets. If they can hit 5,000 a week in each factory by the end of the year, and then you put everything together with Fremont and Shanghai, you're starting to look at a 2 million vehicle run rate. Then you're looking at a 3 million vehicle run rate for 2023. But I think, again, I have to temper my expectations. Maybe it's going to be a 2 million vehicle production rate by the end of the year, but it's not going to be a 2 million vehicle a year delivery rate. And maybe it's going to 3 million vehicle production rate at the end of 2023, but it's probably not going to be a 3 million vehicle delivery rate at the end of 2023. So very unlikely we're going to hit 2.5 million vehicles in 2023. Even 2.3 million is starting to look like a stretch. I think that's still possible, but maybe we should be looking at 2.2 million vehicles for 2023. And then what happens with average selling price? And Cybertruck comes in, that's probably going to raise average selling price, but Cybertruck's going to be small for 2023. I don't think we're expecting high volumes. There is some good news about Semi coming in. The Semi is fairly low volume. So again, even though it's a big number, it's probably not a big impact on average selling price. And I'm not sure they're going to count it in the same as passenger vehicles. So that's a struggle. I think the big nut for 2023 that's going to make a difference is, can they ramp Megapack? Can they ramp Solar? Can they ramp Powerwall? And is that going to start having a significant impact on the bottom line? But we didn't get a lot of that in this call.
In fact, just yesterday, if you extrapolated yesterday's build rate, it would be 2,000. Our production of 4680 cells has tripled in Q3 compared to the previous quarter.
Rapid increase in production of 4680 cells. I think later we're going to hear something like they're producing enough battery cells for 1,000 cars a week. I think that's reference to Model Y. I think those are roughly 70 or 80 kilowatt hour packs. So 1,000 a week would be 80 megawatt hours a week. 80 megawatt hours a week would be 4 gigawatt hours a year. A long way to go, but tripling every quarter is a good sign if they can continue tripling every quarter.
We are finally gaining rapid traction on the 4680 cell. Its output is growing rapidly, and we expect it to start incorporating in cars and having it be a significant portion of our production here in Texas in the coming months.
So that says it's not a significant portion of vehicle production in Texas yet, which is something I did. One of the things I called right is it seems like they're not making a lot of 4680 Model Ys in Texas. There's really an open question. Where are the 4680s going? If they're making a really high volume of 4680s and they're not going into Model Ys, because my impression is a lot of the Model Ys coming out of Texas are 2170 Model Ys. Where are the 4680s going? And later in the call, we're going to hear they're not going into Tesla Semi. I don't know if they're just stockpiling 4680s. Somebody else I saw suggest they were going in mega packs. I don't think they're going in mega packs. It's unclear to me where are the 4680s going because they should be making a very high volume of 4680s. And there's going to be more about 4680 later in the call.
We also have our second generation of manufacturing equipment for 4680 cells in Texas, which continues to show great progress along with our original pilot line in Fremont.
Okay, so that one I don't think a lot of people caught. Next generation of 4680 cell equipment means that they are implementing some new technology in their manufacturing of 4680, which I believe is focused primarily on volume rather than improving the energy density of the battery cells. This is one of those questions is that it seems like the current energy density of the 4680 cells is not particularly high. It's not bad, but it's not maybe higher than the 2170 cells. But the long-term plan for the 4680 is to get to significantly higher energy density. So is this next generation of battery manufacturing equipment designed to improve energy density? I don't think so. I think their focus is we got to make a lot of these cells. And I think, and later in the call, we're going to hear this also. They think they're going to get their cost per cell down to $70 a kilowatt hour, which is a really big deal. Because I think right now they're paying probably $100 or more per kilowatt hour for battery cells, even for the lithium iron phosphate cells. So they can really drive their cost down if they can get that down to $70 a kilowatt hour. Because batteries are a big part of Tesla's cost structure for their cars. I would have loved to see an investment analyst ask the question, what is the point of this second generation of equipment? Is it for volume? Is it for energy density? Where do you see this going? And that question wasn't asked, and it would have been nice to get that, but it's understandable that they wouldn't catch that little detail in that short time. Maybe we'll get some answers to that in the future. My guess is we're not going to get more on that for a while.
The Fremont factory team once again reached record production in Q3.
So that's something we kind of knew. We saw some reports that Tesla Fremont was growing to maybe 12,000 vehicles a week or 14,000 vehicles a week. So they've got record production. The vehicle production capacity number did not change for Fremont, but I'm sorry, that was 12 to 14,000 a week for Model 3 and Model Y. So we're seeing some growth in Fremont. That's a positive. It probably increases when they increase production in Fremont. It probably improves margins in Fremont as well. So that should be a good long-term thing for the business. Maybe that will translate into more in Q4. We'll see about that.
And we intend to keep raising production in Fremont. Regarding Autopilot, at the end of September, we hosted our second AI Day and showed the first prototype of our Optimus robot, the latest updates on our Dojo training computer, wide range of improvements of full self-driving software. Our vehicles have now driven nearly 60 miles in full self-driving beta mode, and this number continues to grow exponentially. Our goal with that AI Day was recruiting, and we've seen a massive influx of world-class artificial intelligence engineer and scientist resumes. So,
just want to touch on a couple things there. One, the improvement, I don't see how autopilot miles or FSD beta miles are increasing exponentially. It seems like they've increased the number of people driving to about 160,000 people have FSD beta. Those people are driving the same number of miles before as they were after. So when you go from 100,000 people driving it to 160,000 people driving it, you're not going to get to 1 million people driving it unless you get 1 million people to pay for FSD. So I don't quite get the exponential growth. It's growing fast, but I'm not sure I see the exponential there. And especially, when you're going to go to FSD beta in wide release, well, how many people is that? We don't really have a number on how many people have purchased FSD. My sense is like it's only in North America. There's about 2 million Teslas on the road. What percentage of them have bought FSD? Maybe, maybe 200,000, maybe 250,000. I don't see the potential for exponential growth there unless a lot of more people buy FSD or subscribe to FSD. And, maybe Elon sees that's going to happen. I don't see that happening until FSD gets to the point where you can go to sleep in the back of the car. I love it. I really enjoy driving FSD Beta. I personally don't think I'd be comfortable. I wasn't comfortable driving my Model X without FSD Beta. It was very frustrating. I really want to have FSD Beta, but I don't think that that translates to other people wanting it as much as I do. I think Elon drives it every day and he sees how valuable it is, but transmitting the concept to people who have never driven FSD, this is why this is awesome. It's not something you get on one test drive. It's something you get when you've driven it for a week and all of a sudden you're like, I don't want to live without this anymore. And you have to use it when you have it. You know, I know people who have FSD beta even and don't use it. They like driving the car themselves. So I think there's a cap on how much that's going to grow. Regarding the point about Tesla recruiting, AI day driving recruiting, I think it's a really important thing for Tesla's future. Not only Tesla's future, but Elon Musk's companies in general. His companies attract the top engineers. The top engineers do the most innovation. You're going to see the most growth in a company that is the most innovative, that is the most cost effective in its innovation. There's a lot of great things about Tesla. And probably the number one thing that makes Tesla a great company is its ability to attract the best engineers and get them to work hard and get them to produce and get them to innovate. So that's an important long-term thing. That's not the kind of thing that shows up in the quarterly earnings report. It's not the kind of thing that's obvious in the next 6 months or a year. But when you look down the road to the future, you can see it if you can look that far down the road. And you have to look down the road a few years to really see where those benefits come in. I mean, you see hints of it. You see robo-taxi coming, you see bot coming, but do you really see it? And you see manufacturing improvements coming, but do you really see it? That's a challenge.
It generated a tremendous amount of interest from some of the best AI researchers in the world. I can't emphasize the importance of this enough, because I think it finally has become clear to the smartest AI technologists in the world that Tesla is among the very best. And this quarter, we expect to go to a wide release of full self-driving beta in North America. So anyone who has ordered full self-driving beta or full self-driving will have access to the FSD beta program this year, probably about a month from now.
So FSD beta is going into wide release by the end of the year. Great. What we didn't get was how many vehicles have FSD or paid for FSD. You know, they could have told us that. I don't think any of the analysts asked that question. That would be a useful question to ask. That's going to lead to revenue recognition as well, which doesn't increase Tesla's cash pile, but does increase profitability. So that's another thing that can drive earnings, let's say next quarter, is if it looks like they're going to do significant revenue recognition next quarter as a result of that expansion of FSD. I that could be a bump for earnings per share, but that's kind of like a tweak. It's not really a fundamental change in the company, in the business of the company, from my perspective.
And then obviously anyone who buys a car and purchases a full self-driving option will immediately have that available to them. So the safety that we're seeing when the car is in FSD mode is actually significantly greater than the safety we're seeing than when it is not, which is a key threshold for going to a wide beta.
So this does not surprise me at all. I will say my personal experience driving FSD beta is that I feel safer with the car driving and me supervising than I feel with me driving alone or I feel with someone else driving. The car drives very safely. Now, safe is an interesting term because it does drive safely. It sometimes drives awkwardly. And this is, like, I think we're going to talk about this later, but you're going to be able to drive from home to work without touching the steering wheel. Now, does that mean we're going to remove the nag? Like the car is constantly nagging you to touch the steering wheel to show that you're paying attention. Does that mean they're going to remove the nags? I tend to doubt it, right? I think the nags are still going to be there. You're still going to have to touch the steering wheel. I think the point is you're not going to have to take over. And in a normal drive from home to work, and this is probably after you've backed out of the driveway and before you parked the car in the parking spot, the car should be able to do everything. Now, Elon did say actually smart summon may be coming, so maybe that's going to get better. We'll see. But I'll say my own experience when I'm driving on regular roads that don't have something odd going on, the car drives really, really well. It will occasionally slow down when it shouldn't. It might refuse to make a right turn on red in a place where it should. There's a couple of little details like that that are off. It does make some poor lane choices, but I think that's getting better. When there's a problem, when there's construction, for example, the neighborhood I'm living in right now has construction going on. It does not handle construction well. It sometimes handles construction well. My neighborhood, the construction we got right now, you know, Detour, road closed, it's ignoring those signs. And, road closed sign is something you should probably notice. You should probably follow a detour sign. So that's something that has to be added later. So, but in the ordinary drive that doesn't involve some sort of significant construction, yeah, it should be good. I'm driving along and the car's trying to make a right turn, and there's a piece of construction equipment that's backing up. And you very clearly can't make a right turn. And there's an easy choice to make a left turn to get out of the neighborhood, and the car doesn't know to do that. So when there's something odd going on, when there's a car parked in the road blocking the road, and you and I would make a U-turn and go out a different way or something like that, I don't think the car is going to get there. That is going to take another year before they get to that level. Maybe I'm wrong. Maybe it's 6 months, but it's going to take a while to get to that level, and maybe it's going to take longer. But again, I'm agreeing with Elon on the day to day going from point A to point B. Nothing particularly unusual on the roadway. The car should handle it fine. It will be safe. Like I said, it won't drive the way you'll drive. It might annoy you with the way it handles certain things, but it will get you there safely. It will get you there, and it will get you there safely, and it'll get you there in a reasonable time.
Let's see. With respect to demand, we've got a lot of questions about demand in recent weeks. I can't emphasize enough. We have excellent demand for Q4, and we expect to sell every car that we make for as far into the future as we can see.
I thought this was a really big point for the long-term future. We constantly hear about Tesla. Oh, there's a demand problem, there's a demand problem, there's a demand problem. There's a demand problem in China, there's a demand problem in Europe. The competition is coming, and this is Elon confidently stating we have enough demand for every vehicle we make. There's no demand issue. This came up in the Q&A at the end. I thought the answer was a little less strong than this at the Q&A at the end, but it is somewhat reassuring. I actually haven't been worried about it. I think demand is great. I don't see a demand issue. I think people are manufacturing in their mind there's demand issues when there aren't. But, it's good to hear Elon say it. We'll see what happens later in the call. We'll go over that later in the call in the Q&A, and we'll see what how that sounded and what you guys think.
The factories are running at full speed, and we're delivering every car we make and keeping operating margins strong. We're still a very small percentage of the total vehicles on the road. Of the 2 billion cars and trucks on the road, we only have about 3.5 million. So we've got a long way to go to even reach 1% of the global fleet.
If there's 2 billion cars on the road globally, then 20 million would be 1%, and they're at 3.5 million. I was surprised to hear 3.5 million. I thought they just barely got over 3 million recently. So Tesla is growing fast. The path to 20 million vehicles on the road is a ways away, but not that far. And then the real goal, of course, is 20 million vehicles a year. And I think they're still confident they're going to get there. There's a really nice nugget about the next vehicle that we're going to catch in a few minutes.
Based on many things, but certainly questions I get on Twitter about buybacks. And I think every one of our board members has gotten questions about buybacks. We've debated the buyback idea extensively at the board level. The board generally thinks that it makes sense to do a buyback, but we want to work through the right process to do a buyback. But it is certainly possible for us to do a buyback on the order of $5 to $10 billion, even in the downside scenario next year. Even if next year is a very difficult year, we still have the ability to do a $5 to $10 billion buyback. This is obviously pending board review and approval.
So, you guys, if you follow me, I just did a video with Alexandra Mertz. Check out my video with her. She's a proponent of the buyback. Gary Black's a proponent of the buyback. There's a lot of people want a share buyback. I think a share buyback is a terrible idea. But, Elon and the board know more than I do. My take is I've got my investment in your company. I've got my cash in Tesla, and I want Tesla to deploy that capital in a way that grows the company fast. And I'm concerned that the choice to take capital out of Tesla offers, rather than investing that money in going forward, Tesla is spending that cash back to shareholders, is an indication that you don't see how you can deploy that capital to grow the company as fast as possible. I think there's some good explanations for that. Like, yes, we have the capital to grow, but we don't have the engineers to grow. Like I think that comes up later in the call in the Q&A, that they just don't have enough engineers, that the world does not produce enough engineers for Tesla to deploy that capital in a way to accelerate the growth. So that in a sense makes sense, but just me personally, I'd rather you hold the cash in Tesla's, in case you see an opportunity to use that cash for some way that's gonna grow the company. I'd rather Tesla hold the cash than you give buying shares is effectively giving cash back to shareholders. Now, I'm not selling, so you're effectively increasing my stake in the company, and I like that. In other words, if you have a million shares, yeah, if you have 100 shares of a company and you buy back one share, then everybody who owned a share now owns an additional percent of the company. You buy back 10 shares, now there's 90 shares held instead of 100 shares held. So if I still hold a share, instead of having 1% of the company, now I have 1.1% of the company. So I don't lose. I believe that fundamentally Tesla is a good place to deploy capital, and I'd like to see them deploy capital in a way efficiently that grows the company. And but that's what they're doing. That's what a lot of people want. It's probably going to help the share price when they do a share buyback. I think they're pushing that to 2023. And they're generating so much cash that I suppose it's easy for them to throw 5 or 10 billion into a share buy. If they're going to generate, 3-4 billion dollars a quarter in free cash flow, and they're not, they're investing $2,000 in capex. Sorry, if they're investing 2 billion in capex out of the 5 billion that's coming in, and they don't think they can deploy more than 2 billion in capex a quarter, well, you're just generating a bigger and bigger cash pile. I suppose the share buyback's a reasonable thing to do with the cash. Is it better than holding the cash on the books? I guess. I don't know. But greater minds than mine say this is the right move, so I guess it's the right move.
So, in conclusion, while the market themes revolve around the short term, it's very important to focus on the long term. I can't emphasize this enough with investors, and I think long-time investors obviously recognize this with Tesla. You have your sort of local ups and downs, but the long-term trend has been extremely good. And several years ago, I said, I think on an earnings call, that I thought it was possible for Tesla to be worth more than Apple, which was then the highest market cap company, I think, on the market. And Apple at the time, I think, was around $700 billion. I said it required incredible execution, at least some luck, and we didn't indeed achieve that. Tesla went, in fact, far past Apple's market cap at the time. And now I'm of the opinion that we can far exceed Apple's current market cap. In fact, I see a potential path for Tesla to be worth more than Apple and Saudi Aramco combined.
Apple's market cap and Saudi Aramco's market cap combined is somewhere between $4 and $5 trillion. So basically, Elon is saying he sees Tesla becoming a $5 trillion company. Currently, Tesla is a $700 billion company. So he's predicting near 10x growth in share price, if not more, which I think is low. I think the robotaxi model generates an insane amount of valuation, and I think bot generates even more than that. But it's nice to hear Elon project that kind of long-term confidence.
Now, that doesn't mean it will happen, or that will be easy. In fact, I think it will be very difficult. It will require a lot of work, some very creative new products, tremendous expansion, and always some luck. But for the first time, I am seeing, I see a way for Tesla to be, let's say, roughly twice the value of Saudi Aramco.
That would be over $4 trillion. Not $5 trillion, it's over $4 trillion. Still, that's a pretty big statement of confidence by Elon. It looks like my summary is getting so long that it's going to be insane if I do this as one video. So I'm wrapping up part 1 here. We're going to dive in more shortly. So please get ready for the next one. Please let me know what you think of this one in the comments. Check out the t-shirts at elonbits.com. Please share and like this video. Subscribe if you're not already subscribed. Check out my other videos. Support this channel on the Patreon, on the Locals platform, as a YouTube channel member. And thank you so much for watching. Get ready for the next one.